Today we are going to focus more on financial analysis. I'm going to focus more on financial analysis. So then after that, we'll continue the past question we are trying to solve last week. And then if we have a lot more time, we'll go into, May 2020 past question as well. And then we call it a day if we have time. So for most of the cases, one of the things you need to understand is like they'll require you to do a little bit of financial analysis. So your numbers game must be on top. You must be able to understand numbers and be able to, analyze numbers. So I'll be taking you through some of the ratios. And look at how we can best understand how to analyze. People are still joining. Look at how best we can still analyze the numbers as they appear in our cases. Okay, so there are all kinds of ratios. Ratios are usually used to assess the financial performance and understand the financial context of a business. So there are all kinds of ratios. And as you can see in the table of contents, you have liquidity ratios, you have solvency ratios, you have efficiency ratios, you have profitability ratios, you have market prospect ratios, you have coverage ratios. So these are different kinds of ratios. You don't have to really memorize them. The best thing is to understand them and be able to apply them and know how to use them in the context of the case given. You do not have to use every single ratio or every single formula. No. What you need to do is you need to know what is relevant to the case you are working with, and then use that as a tool to analyze your case. So after the class, I'll send you this document. I'll send you an Excel sheet, and the Excel sheet, basically what you can do is you can populate the financial statements and it calculates all the ratios for you. Everything has been programmed into it. So that's just about it. Let me show you how it looks like before we move on. So you have a look. So this is how it looks like, right? This is how it looks like. It's a ratio calculator, and basically if you populate everything here, and you populate everything here, populate things here, you populate stuff here, the ratio should automatically calculate because everything has been done. Everything has been done and Excel has done everything for you. So I'll send you this as well. I know you're not going to really use this in the exam, but it can help you as a tool to understand the ratios and how how they work. So my goal here is not just to give you formulas. My goal here is to understand what the ratios mean and the implications. That's my goal. And so with that said, let's start real quick. So let's start with a ratio called, so we've started, this is the liquidity ratio. So liquidity ratios basically tests liquidity meaning how much cash you have on hand or you have access to, so it's able to check, does this Does this business have a lot of cash? You know, do they have a lot of access to cash, or are they hard pressed for cash? Very, very important and very, very key. You need to know how much cash, you know, a business is having, you know, because it helps to check if the business will be able to pay back, you know, any unforeseen liabilities or even foreseen liabilities. You know, so it's a very, very key ratio. And under this, you have the quick ratio, or called the asset test ratio. You have the current ratio, you have the working capital ratio, and you have what we call times interest end. Times interest end. Like I said, you don't need to memorize every single formula. What you are going to focus on more, I'll send you this document because it's a very, very good document. What we need to focus on more is is the implication, you know, is the implication. Hey, today people have joined. Is the implication of the ratio and its impact on the business. So what's the quick ratio? So the quick ratio is basically it measures the ability of a company or a business to pay back its short-term liabilities. You know, the ability of a company to pay back its short-term liabilities when they become due, basically. So, and the reason why it's very, very key is that it's looking at how best the organization can pay for its current liabilities using its most current assets. So when we say an asset is current, or we say an asset is current generally, we mean that like it has a lifespan of a year. It has a lifespan of a year. And we say, and if it's non-current, it means that that's a lifespan of more than a year. But for the quick ratio, we are looking at not just current assets, but current assets that can be turned over quickly into cash within a period of 90 days. Within a period of 90 days. So items like cash equivalents, short-term investments, current receivables. These are current assets that can be turned over within a period of 90 days, usually. That's why it's called quick ratio, you know, quick ratio. It's not just current ratio, but quick ratio, because it's looking at current assets that can be turned over quickly within a period of 90 days. Within a period of 90 days. So it shows us how quickly we can convert assets into cash in order to pay off current liabilities. How quickly we can turn assets into cash in order to pay off current liabilities. So, so this is the formula. In the formula, you would realize that quick ratio is equal to cash plus cash equivalents plus short-term investments plus current receivables all over current liabilities. And if you look here critically, you would realize that inventory has been left out, because the assumption here is that inventory can take a longer time to turn over, more than 90 days. So even though inventory is a current asset, it's not factored in here. We are looking at cash equivalents, short-term investments, and current receivables. Very, very key. Very, very key. So like I said, I give a background to the ratio, the formula, then what it means. remember I said that if the ratio, remember I said that the ratio basically checks how the ability to pay, the ability to pay using your quick current assets to pay off your current liabilities. Very, very important. Very, very important. So what does it mean when an organization has a high quick ratio? It means that basically it's favorable and that there are more quick assets. It means that there are more quick assets that are able to pay for current liabilities. Because in that case, your numerator would become bigger than your denominator. Your numerator will become bigger than your denominator. Your numerator will become bigger than your denominator. So it's favorable. It means that you have, let's say after you add cash equivalent, short-term investments, current receivable, you have 5,000 Ghana cedis. Then your current liabilities are 1,000. It means that you have a quick ratio of 5 times, or 5, which means that you have enough quick assets to pay 5 times of your current liabilities. A quick ratio of 1 means that your quick assets is equal to your current assets. A quick ratio of less than 1, it means that the company is bleeding and it doesn't have enough quick assets to pay off its current liability. Very, very key. If the company has a quick ratio of 3, it means that the company has thrice as many quick assets than current liabilities. Very, very important. Very, very important. So you can use this ratio to ascertain how quickly an organization, can pay off its current liabilities. So for example, the case we are discussing last week, right? You can look at the quick ratio to see how well they're able to pay off, because we saw that a huge chunk of their revenue was being spent out as cost. So you want to understand what's happening. You can use quick ratio if you want to see how the amount of quick assets they have, the amount of current liabilities they have, and how well they're able to pay it off. It's a very, very important ratio. Very, very. The reason why inventory, even though it's a current asset, is not included in this formula is that sometimes inventory can take more than 90 days to turn over. And so here we are looking at quick assets, quick assets that can be quickly converted into cash within a period of 90 days. Very, very key. Then we have current ratio. Current ratio. The current ratio is quite similar to the quick ratio. The current ratio is quite similar to the quick ratio in the sense that the current ratio, you have you are looking at how quickly you can pay off your current liabilities using your entire current assets or your total current assets. In the quick ratio formula, you're not using your total current assets. You are looking at those that can be quickly converted into cash within a period of 90 days. This one, you are looking at your entire current assets. Looking at your entire current assets. So you are looking at how quickly your short-term assets can cater for your short-term liabilities when they become due. When they become due, it's quite similar. So you see the ratio here, the formula here is current assets over current liabilities. Current assets over current liabilities. Current assets over current liabilities. That's the ratio. So you see it's the total current assets over total current. So in this current assets formula, you would have inventory or stock, it will be parts. But in the quick ratio, it won't be parts. So this ratio helps creditors and investors to understand the liquidity of a company, and how quickly they'll be able to pay off their current liabilities. Like we always know, cash is king. Cash is king. And a higher current ratio is favorable. It's favorable for the company. And the lower current ratio is unfavorable, because it means that the company doesn't have enough current assets to take care of its current liability. The current ratio also shows the debt burden of the company. If the company has a lot more current liabilities, then it's going to struggle operationally. It's going to, struggle and always be catching up, always be catching up, always be catching up, always keep catching up. So all you want to do as a business is make sure that your current assets are bigger. The numerator is bigger compared to your current liabilities. Very, very key. Then you also have the working capital ratio. The working capital ratio, which is it's basically the same as it's basically the same as the current ratio. If you look, it's basically the same as the current ratio. And so same understanding, because the current ratio it tests, basically your operations and sees how quickly you're able to, turn around your current assets to pay for your current liability. So I won't touch on that too much. So let's move on to the times interest earned ratio. Times interest earned ratio. Times interest earned ratio. So the times interest earned ratio, the formula is earnings before interest and taxes, or EBIT over interest expense. So what are we trying to achieve here? It's also called, sometimes you see it's called the interest coverage ratio. What are we trying to check here? We are trying to check how our earnings are able to cater for interest payments. Remember, interest payments happen periodically, usually monthly. So you want to see, this ratio is testing to see how well our earnings are able to cater for interest payments that happen periodically over time. Very, very key. It also measures the proportion of income that can be used to cover interest expenses in the future. Very, very important. So that's the focus of the times interest earned ratio. It helps you cover, it helps to measure how earnings is able to cover. So if you have earnings of 2,000, earnings before interest and taxes of 2,000, you have interest expense of, let's say, 5,000. It means that your earnings before interest and taxes is not able to cover. It's not able to cover your interest expenses. Interest expenses are mandatory, so you would want to see how best you can cover it. And that's where this ratio comes in. That's where this ratio comes in. So, for example, if you have a times interest earned ratio, that is above 1, it means that the company has enough earnings before interest and taxes to cover their interest expenses, which is favorable. Which is favorable. If it's less than 1, it's unfavorable. And it shows that you are risky as a company. Okay. So what's the pattern you are seeing here with these liquidity ratios? What's the pattern? If you realize that the reason why I don't like chewing and pouring these formulas is that there's a pattern, and the pattern is that if you look at the numerator, right, and you look at the denominator, you would see some relationships. So you see that the numerator takes care of the denominator. The numerator takes care of the denominator. Or, in other words, the denominator is the liability and the numerator is the asset. So the numerator is always taking care of the liabilities. So that can help you remember, how to, write your formulas and other things. So I know that the numerator is always something positive, like an asset or something. So for times interest earn ratio, interest coverage ratio, I know that it will be like earnings before interest and taxes over interest. Very, very important. The numerator takes care of the denominator. The numerator is supposed to pay off the denominator. Very, very important. Very, very important. Okay, then we move on to the next. Solvency ratios. Solvency ratio. So solvency ratio, we have debt to equity ratio, we have equity ratio, and we have debt ratio. So what are these? What is the debt to equity? When you hear debt to equity, the two there means over. So it means debt over equity. It's like the way you write your ratios, 3:4 or 3:4. So it means 3/4. So debt to equity ratio, it simply measures your total debt to your total equity. Every company's financial or capital structure comprises of debt and equity. A lot of companies. These are the two main kinds of capital. Two main kinds of capital. So a higher debt to equity ratio simply indicates that there's more, the company is highly leveraged. When we say highly leveraged, it means that there is more debt. The company relies more on bank loans rather than their own money, their own equity, their money from their own shareholders. They are more focused on getting money from outside and getting money from within. And every industry has their own benchmark. So the debt to equity ratio is simply equal to total liabilities over total equity, or debt over equity, basically. Debt over equity. So if we have a lower debt to equity ratio, what does it mean? If the debt to equity ratio is low, what does it mean? It simply means that this is a business that is stable. This is a business that is stable. And that we can work with. It's a business that is stable. Because once you have a lot of debts in your portfolio, you are exposed to what we call financial risks. Because there's a risk that you might not be able to pay. There's a risk that you might not be able to meet the full obligation. There's a risk that you face penalties. All of that. So that's key. That's very, very key. That's very, very key. That's very, very key. So a lower debt to equity ratio usually implies an organization that's more stable. A high debt to equity ratio shows that the business is risky. So if I'm a creditor, I'm a bank, and I look at your debt to equity ratio and I see that this debt to equity ratio is really, really high, what will I do? I might not give you the money, because the more I give you the money, the more I give you the loan, or I give you more loans, you might not be able to pay. and that might create problems for my bank. So banks usually look at this, creditors usually look at this. And as we go through the financial statements, these are some of the things you should be looking at and trying to understand. Yeah. Some people also call it gearing ratios. Solvency, some people call it gearing ratios. Then we have the equity ratio. The equity ratio simply measures the proportion of assets, that are financed by the owners of the business. The owners of the business. We want to understand, when we take our total assets, how much of it is financed by our own shareholders? Because we want to check how sustainable and how solvent our business is. We want to understand, is our business really sustainable? Is all our money coming from outside, or we've been able to generate some money from inside? Okay, so the equity ratio, the calculation is total equity over total assets. Please mute your microphones, okay? It's total equity over total assets. Total equity over total assets. That's the formula we have. So we are looking at basically the proportion of assets that is financed by shareholders' money. So a high equity ratio is favorable for the business. High equity ratios is favorable for the business because you don't want a situation where your company is financed a lot more by external bank loans. You need money from the inside or money from shareholders, like I've already said, to finance your business. So if you have a high equity ratio, that's a good sign. That's a good sign. Okay. If your equity ratio is also low, that's not a good sign. Okay. So we've talked about equity ratio. Now let's move on to debt ratio. Debt ratio. So if the equity ratio is equity over assets, debt ratio will be what? Debt over assets. We want to know the proportion of our assets that is financed by debt. Debt. It's also a solvency ratio. So like I said, we are trying to measure the financial leverage of a company, So companies that have a higher debt to asset ratio, right, are considered to be financially leveraged. They are highly leveraged. When you hear the word leverage, it means debt. When you hear the word leverage, it means debt. Very, very key. Always remember that. So companies that are highly leveraged are considered to have a lot of debt. So the debt ratio is basically your total liabilities over your total assets, or your total debt over your total assets, any way you want to say it. So if a company has a high debt ratio, it means it's very risky. It means it's very risky. If it's high, it's very risky. And if it's low, it means that it is not as risky. You would want to loan money to a company that has a low debt ratio because there's a likelihood that they will pay you back. There's a likelihood that they will pay you back. So that's very, very important. Very, very key. Very, very key. You have a debt ratio of, let's say, 1. It means that your total liability is equal to your total assets. You have a debt ratio of less than 1. It means that your total liabilities is less than your total assets, which means that your business is not that much risky. You have a debt ratio of greater than 1. It means that your debt is way higher than your assets. It means that you are highly leveraged and you should look at finding ways to pay off your debt real quick. Okay, then we move on to efficiency ratios. Efficiency ratios. So efficiency ratio, it looks like it looks at 4 key things. You have the account receivable turnover, asset turnover ratio, inventory turnover, and days sales in inventory. Days sales in inventory. These are the 4 key efficiency ratios. 4 key efficiency ratios. So first of all, let's talk about the account receivable turnover. What is the account receivable turnover? Very, very important.